Hello everyone, hope you're all well and welcome back to the YouTube channel. So in this video we're going to be going over how to read the economic calendar. This was actually requested in the comments, so as always, if you are wanting to see something, just put a comment and I'll be able to do it. What we're going to do initially, we're just going to break down what it is, why we use it, and then we will basically look at the calendar and see exactly what's going on, okay? So what is the economic calendar? So it's a form of fundamental analysis, which basically means we are using data releases from countries to give us an insight into a currency's economy, strength, and any other aspect regarding, obviously, the currency. So it is basically just a calendar which itemizes the dates and times of news releases so we can look at the market and potentially trade or avoid certain currencies based off the news events, okay? So by having access to the calendar, we can keep updated on the events. Before they happen, we can plan what we're going to do. And then following that, you're in a little bit of a better situation when it comes to actually being in the market, okay? So why would we use it? So when we're looking at taking trades, 99% of the time, the strategy that I, for example, trade is going to involve technical analysis. That basically means when you're drawing and analysing the charts, that is technical analysis. But then when it comes to fundamentals, which is news driven, fundamental is always going to take over, okay? So when I'm trading my strategy, most of the time I will avoid when news is coming out, simply for the reason that fundamentals will take over. So upon release of the fundamental and economic data, the market is always going to have a huge rush of volume into the market. And when there's a huge rush of volume, that is where manipulation is always at the highest. That means the market makers, they can move the market one way and then the other just to take us, retail traders, out of positions, okay? So following on from that, if the news is positive for a currency, there's a high chance that the market will actually push down to catch people out before making the move up, okay? Therefore, that's why when news comes out, I personally like to avoid the market because my strategy is technical, so I don't want any fundamental reason for the market to not respect what I want it to do, okay? So the fundamental factors have a large effect on the market, and this is compared to, let's say, key levels, Fibonacci's, things like that. If some news comes out and it's not as what it was predicted to be, key levels go out of the window. Price will fly through these levels simply because the news is what's moving the market, okay? So let's look at the economic calendar on face value. So this is it here. Let's just have a look at reading the calendar. So this calendar I've got up here is on what we call FX Street. So if you look here, this is just a website called FX Street Economic Calendar. If you just type in economic calendar into Google, the first one that comes up will be FX Street. It basically has everything. If you look at the top, if I go up to the top quickly, you can filter the dates and things like that. So you can do it date specific. You can filter the currency. So if you only want to see, for example, US dollar news for the week or for the month, etc., you can apply it and it will bring it up. If I just get rid of that, only US. You can do the impact of the news, which we're going to break down now. But yeah, overall, everything you need is going to be on this calendar, okay? So let's first read this calendar left to right. So on the left-hand side, you have the time. This means the time that the news is going to be released, okay? Super simple stuff. You can plan that for your trading session, your trading day, whatever it may be. The next one, where it says event, the first part is going to be the currency. So there will be the flag and also an abbreviation for the currency. So we've got Australian dollar, Japanese yen, Swiss franc, and euro. Next to that is going to be the type of news. So you've got consumer inflation expectations, employment change, full-time, part-time employment, unemployment. Then you've got, for example, the monetary policy decision, which is the interest rate for euro. So you can see that it itemizes the exact news which is coming out. And then therefore, that's why you can say, well, I don't want to trade Australian dollar in and around 2:30 on Thursday morning on 14th of September. Why? Because the market is going to have an injection of volume that I don't want to be a part of. okay? So here just basically says the currency and the type of reading that it is going to be. This is an important one here. You then have the impact section. Just like a traffic light system, yellow, low, basically means it's not high. Orange means it's medium impact, and then red means it's high impact. What do you think that means? That means the low impact stuff isn't going to have as much of an effect on the market. The medium stuff is going to have a bit more of an effect, and the high impact stuff is what's really going to move the market, okay? So if we're looking at these news releases here, you've got unemployment and employment change are both high impact events. This is because this is going to move the market more than part-time and full-time employment figures. If we look down here, we then have things like, industrial production for the yen, which is super low impact. We're not going to pay attention to that unless it's a big misreading, which we're about to go over now. So then again, you've got the monetary policy, high impact, 4%, etc. So these high impact and medium impact events are the ones that you want to keep an eye on, okay? Now let's go on how to read the actual figures. Now, this actual section here is not initially going to be there. So if we go to the next slide, I've just got an example like this. You can see how there's a figure in the actual because these events have already happened. These events that are upcoming, where they're obviously highlighted white, that means the news has not come out yet. Therefore, this actual reading here will not be out. The actual reading is basically just at this time, when it's due to be released, this will be the figure that is printed. So for future events, this is not going to be there. So the first thing that we want to pay our attention to is the consensus. The consensus is the prediction. The prediction of what the result is going to be. So that is what we call being priced in. Priced in basically means the market is going to use that figure as what the actual is going to be, okay? So for example, if we are looking at this here, the consensus for employment change was 23,000, okay? So the market was predicting that 23,000 was going to be the reading. So Australian dollar was at that point. If we look next to that is the previous. So the previous shows last time this news came out, what was the reading? So the previous and consensus in this situation for employment change, the previous was minus 1.4. The consensus was 23,000, so a 24,000 increase, which is obviously better. So the market was predicting better employment figures. If we look at unemployment, the previous was 3.7, the consensus was 3.7, so that was as predicted. So basically it was due not to change. If we then look at the actual, you can see the actual comes out at this point is pretty much 65,000, which is about 40,000 better than the consensus. What happens in this scenario? Well, what happens is that Australian dollar will get strong because employment change being better than expected means more people are employed. So it's better for the currency and better for the economy because there's more jobs created, more people are going to be spending money. It's a domino effect, okay? So just by looking at this, we can say, well, the Australian dollar is going to be stronger than expected. What does that mean for us? That means that we don't want to be selling Australian dollar. If you want to look to buy Australian dollar, absolutely fine. If you want to avoid the market, absolutely fine. But what you don't want to be doing is anything in the opposite direction. If this is green, that means good. By it being green, you want to basically look to buy the currency depending on the rate, okay, and what actual the figure is. So in this situation like this, where unemployment was 3.7 last time, 3.7 prediction, and 3.7 this time, that may not move the market. The biggest times you're going to see market moving is when there's a big deviation from the consensus. So the consensus was 23,000, the actual was 65,000. That's a big difference. So now the market has to price in and move according to the employment because all these figures are going to, in total, affect the interest rate. So if employment is good, unemployment has stayed the same, that may be in a better position to increase the interest rate of the Australian dollar, which overall is beneficial for the currency. Okay, so that is basically how you do it. And then you just basically, now looking at this, let's say durable goods here for US dollar, previous was minus 5.2, consensus is minus 0.5. So if this comes in better than 0.5%, that's going to be good for the dollar. If it comes in lower than 0.5%, it's going to be negative for the dollar, because 0.5% negative is what's priced in. Okay? So that is how you can use the economic calendar to find positions in the market. You can simply just look and obviously see which way the market is potentially going to go. If you do want to see any videos, please just comment and I'll be sure to make them. But for now, guys, that's it, and I will see you next Thursday.